This technical analysis for stock ticker SOFI is for educational and informational purposes only and should not be considered financial advice. Always conduct your own research before making any investment decisions. This is the brief on the high volatility trading strategy suggested for SOFI's upcoming earnings report. Okay, so we're diving into an options play here, specifically designed to potentially capitalize on the big swings expected around SOFI's earnings on October 28th. This one's all about timing and hitting those mechanics just right. First off, you gotta understand just how extreme this setup is. SOFI is expected to make a really significant move, like 13.5% right after earnings. Why? Well, there's massive uncertainty, partly because its valuation is, frankly, kind of wild at 50 times price to earnings. Now, that just means it's pricey compared to its profits. And get this, the sector average is only 9.6. No wonder analysts are all over the place with targets from $12 up to $31. Second, the actual trade idea centers on that volatility. The suggestion is buying what's called an at-the-money straddle, basically buying both call and put options right around the current stock price. You do this on Monday before the earnings hit, and crucially, try to keep the cost under 2% of your total position size. Then the plan is to be completely out by Halloween, looking for maybe 8 to 12% net returns. Oh, and if things look bearish, only go short if it really breaks below $26.43 with lots of volume. Finally, let's talk risks, because there are three big ones. First is IV crush, implied volatility just collapsing right after the news drops, potentially hurting your option prices. Second, valuation whiplash. Yeah, that 50x PE means any hint of disappointing guidance could trigger some serious sell-the-news action. And third, watch out for thin pre-market spreads. Option liquidity might just be poor before the opening bell. So bottom line, this SOFI pre-earnings play is about grabbing gains from a big price swing, but it really hinges on carefully managing those risks like IV crush and valuation sensitivity, while being super precise on your exits.